The problem that most people get into is selling their shares when they see that their stocks are down to prevent losing money. What most people don't realize is that by selling when you're negative, you're actually committing yourself to losing that money. Just because you're negative now doesn't mean that the share price won't go back up. But if you sell when you're negative, it doesn't matter if the share price does go back up, you committed yourself to that loss. There are only two times that selling works in your favor. One, you've reached your profit target, and two, you're anticipating the market to fall way lower to re-enter at a better price. But for our sector investor growth strategy, this poses two problems. One is that we don't have a short-term profit target. We want our money to compound over time. And two, we chose to invest in growth stocks because they tend to increase in value. Unless you just started investing, the likelihood of your share price dropping below your entry price is pretty low. But even if you did just get started, cheaper stocks are a good thing, because a recurring investment will lower your dollar cost average, which will ultimately give you a much better return in the future. Here's the real question you need to ask when you find yourself with a negative P&L. Do you want to acquire more shares or not? This goes back to the difference between growth investments versus speculative investments. Our sector ETFs grow because the largest companies in the sector are the industry leaders. Industry leaders continue to grow because they're constantly striving to beat their competition. Since all of these companies are bundled into an ETF that will automatically weight itself towards the winners, we tend to see consistent growth over the long term. This means that our growth stocks will more than likely be profitable in the future. With growth stocks, you absolutely want more shares for a cheaper price. When the price drops, that doesn't mean you should be worried about selling. That means you should be excited to start buying at a discounted rate. This will give you a much bigger return in the future. The problem is most people think that investing requires you to execute speculative strategies, and this isn't what we're talking about. With speculative investments, generally you don't want to acquire more shares. The mentality in this type of trading is breakout or bailout. With a speculative investment, ideally you should have a budget, a profit strategy, and a protection strategy. If you don't profit right away, you don't want to leave that money on the table and hope for the best. You want it back so you can immediately use it somewhere else, even if that means taking a small loss. This goes directly against our sector investor growth strategy. Not only does this go against our sector investor growth strategy, there are also several reasons why selling works against you. As soon as you sell a stock or an ETF, you're subject to taxes, fees, and pattern day trading rules. Here's what you get to look forward to every time you sell. First off are fees. Depending on your brokerage, they may charge fees every time you buy or sell. That being said, they are legally obligated to disclose these to you, and their fees should be easy to find on their website. Most brokerages don't charge fees for trading stocks, but some do, so make sure to check with your brokerage. Second are taxes. Every time you buy and sell a stock, you create a taxable event. The common misconception is you only get taxed when you transfer your money from your brokerage to your bank account, but it doesn't work like that. Like I mentioned earlier, there are no penalties for transferring money from your brokerage to your bank, but you will owe taxes on any profits you make from selling a stock or ETF. The last downside of selling is that if your account value is less than $25,000, you will be subject to pattern day trading rules. This is an absolutely terrible regulation put in place by the US government that only negatively affects people with small accounts. The rule works like this. If you buy and sell, or sell and buy the same stock within the same day, this is considered a day trade. If you execute 4 day trades within 5 days, your account will be flagged for pattern day trading. If this happens, you'll be locked out of making any trades in your account for 90 days. Because of this, don't attempt to day trade in your stock account until your account is greater than $25,000. What's the best way to get your account greater than $25,000? Buying growth stocks like the ones in our sector investor strategy.